markets. What we're going to do here is actually look at how people will physically hedge their volumes, their gas volumes. And when we're looking at European markets, for example, we're looking at where these are being redelivered into these gas-to-gas markets. Now, this has two good benefits to us. One is that it can actually give us price certainty if we fix the price going forward, but it will also give us a delivery certainty. It will actually give a physical buyer if you're selling into the market. And also for the buyer, it gives them certainty of what the price will then be. So these forward prices that we see will give us a price certainty for those forward deliveries. But the prices will actually change over time. And this is because these markets will react to portfolio managers buying and selling on a daily basis to meet their supply and demand obligations at each hub. So this will then affect what the price will be according to the daily demand. So in very simple terms then, if we're looking at a simple physical hedge for a seller, what we're looking at here is the agreement to fix a forward price over a certain time, and that will give us certainty for income. And that gas will then be delivered at a fixed price. Now, that fixed price is what is discovered by the market at that time. So for the seller, what they're looking to avoid here is if the price goes down, they're going to get less revenue, less income, but they will also get a potential upside loss. Now, the upside loss on this is why some people don't like going forward and fixing. It's the question of what if. What if prices go up? I'm not going to lose revenue. But of course, with this, we've also got to look at the fact that, well, what if they go down? So price fixing will give you the certainty of what that forward price will actually be. If we're looking in terms of the buyer, well, the buyer's position is the opposite. The buyer doesn't like the price to go up because they have to pay more. So by fixing that forward price, they will actually receive gas at a fixed price, and they're guaranteed a physical delivery over that period. But of course, whilst you get protection against prices rising, you will also get opportunity lost on the downside. We do have further complications because the gas-to-gas markets are designed for pipeline gas and for this daily balancing. When you buy or sell a forward month, for example, this is representative of delivering the exact same amount of gas on every single day of that month. And what we have with most European receiving terminals is this 20-day send-out profile. So when you deliver your LNG, it then gets sent out over a period of 20 days of an even amount, shall we say. Of course, the other aspect we've got to think about here are you're unlikely to deliver from the first of the month. Cargoes will be arriving all the time, so they can arrive at any time during that month. So if, for example, it was to arrive on the 20th of the month, your delivery period will be over 2 months. And the pricing between those 2 months may change. So if, for example, you decide to hedge your physical risk by selling forward a December price, this is not going to cover deliveries in January. And this gives us what we call basis risk. In simpler terms, if we're looking at the idea of flows not equaling the hedge contracts, we can see from the blue block here that we have a commitment to deliver a volume that is the same volume as that of our cargo delivery, but our cargoes arriving on the 5th will be sent out between the 5th and the 24th inclusive, which means if you've sold forward physically, you've got a commitment to deliver on the 1st to the 5th and from the 25th onwards to the end of the month. And then this will then give us basis risk between the areas that we don't have gas, our own physical gas coming from an LNG cargo. So you still have that commitment to deliver. So you need to buy that gas forward to balance it. But then you'll also have excess gas on those days where you actually have delivery. So what we'll look at later on is how we manage that as part of the overall risk management.